let's go to our friend Beimnet, BB from Galaxy Digital Trading. Beimnet, good to see you, man.
Thanks for having me on.
As always. I guess markets have been, in crypto markets where I start my day usually, we've seen a sort of a slow grind higher over the last couple of days that has been, I think welcomed by the market, although I wouldn't say it's been super dramatic. Why?
Yeah, honestly, it comes back down to memes.
Yeah.
There was this meme project on Solana that launched about a couple weeks ago called Bonk.
Bonk.
And
I have to say, I love the name.
Oh, it's great. And there's a dog on the
on the
photo.
graphic. Yeah.
Yeah. So people liked it. Created enthusiasm amongst the Sol community. The reason why there was so much enthusiasm is because it started to rally a lot, and it rallied because it's a meme project, and there's a lot of zeros before and after the decimal point.
Yeah, you've told me about the from such a low basis, right? That this what's the term that you like to use?
Base effect.
Base effect. The base effect. Really at play here too.
Absolutely.
Solana was down dramatically after FTX.
Exactly. Just the easiest example. Let's say something goes from $100 to $1. That's a 99% move. But if it goes from $1 to $2 afterwards,
that's 100% up.
That's 100% up.
Yeah.
And so with a lot of crypto, there's a tremendous amount of base effects at play. And so when you had a retail phenomenon like Bonk come out. And you had a heavy short base in a name like Solana where funding was really negative, and it tends to cause squeezes.
Yeah.
Because it's like, okay, I have a $20 million short on, it goes from $8 to $12, right? I've just lost $10 million out of thin air.
Right.
And so
for
that
what feels like a small move in
super
Sol historically.
Small. The thing was at 200 a year ago. If it goes from 8 to 12, that's not a big deal.
But it's a 50% move.
50% move.
Right.
And so there's a lot of base effects at play here, particularly in the alts. And so what you've had happen over the past week is anything where people were short, especially stuff where base effects are very relevant, that stuff got squeezed, and you led to forced liquidations during periods of low liquidity, and that broadly caused the market to rally.
They have to go back and buy back their shit, and if they're physically short, a classic short squeeze. So it
doesn't feel fundamental. Let's put it that
way. Fair enough. And the bonk, but the fundamental. Well, hold on. First on bonk. Actually kind of an interesting project in this way that I'll say, which is this is a meme coin, but it was airdropped to NFT holders on Solana.
Yep.
The team, I guess, had an allocation for themselves, but they burned it, provably.
Yes.
So it becomes a fair launch dog meme coin that rallied some excitement, at least to use the chain, right? You'd go out on chain and get it or whatever. And you could see this in on-chain data on Solana. There was a lot of activity around this. Yeah. At a time when they desperately needed some some shot
hopium.
in the arm. Yeah, some hopium. But it really, some will say, what can you do with Bonk, right? Nothing. It's useless, right? And this has been the argument from some Web3 investors that I know where they say but the token itself can create, even if it's only a token. Think about the word token. Literally means like a placeholder. Right? Mm-hmm. Even if that's all it is, it can be used to incentivize and energize a community, which is interesting. It appears to have been what had happened here.
It's not going to energize smart money.
No.
It's not going to energize large pools of capital to move into the space.
And when the knockoffs come out, like Bank, Bonk, right? They're not going to do anything. But so it's not a bullet you can fire that often as a community but there was a lot of activity there. I think that's right.
That was the catalyst.
And then the fundamentals, with a lack of forced sellers in other assets like Bitcoin and stuff.
Yep. Where
is the pain trade?
It's higher.
It's higher.
It's higher for sure. I think there's been a lot of de-risking that's happened. People have gotten positions down to their bare bones, essentially. Most crypto native folks that I talk to that deploy capital in this space have been very cautious and defensively positioned. That's the same for basically all risk assets for the most part. And so the pain trade's definitely higher. If you just think about it, if ETH in the first 10 days of the year is up, 10%, right? There's probably a lot of guys that don't have it on in size, and their investors are going to be like, okay, ETH's up 12% in 10 days of the year. You're only up 2%. Like, what's going on?
Yeah.
And so, there's some of that at play. But broadly speaking, I think the macro backdrop has been fairly constructive to start the year. Last week we had the soft, ISM figures that caused the market to rally, the soft average hourly earnings figures. And so the macro backdrop has been okay. And then if you think about what crypto is doing to start the year, there was so much bad news that came out, to start the year. There's the OCC stuff, the Voyager Binance investigation. I mean, it was literally like endless.
The drip on FTX and
drip,
related stuff,
etc. And the market couldn't go down.
Right.
It tells you seller exhaustion.
Yeah.
Right. And so the moment you had any bit of good in the space, that caused short liquidations and prices to rally, etc.
Yeah. I mean, I've been saying this that if you're not, when you talk about how it couldn't go down, right? These things have a large and dedicated group of people that believe in them, own them, want to build on them, use them, and at some point there
is a floor.
Yeah, there's a floor, and I've said for a long time that there's a cult of decentralization. That's part of what is driving. This is a social movement.
No, absolutely.
And there are sub movements inside it, obviously, with different goals and roadmaps. But like, this is broadly more than simply a technology or an asset.
No, I mean, I think every single investor or person that thinks about this space in a critical way is definitely focused on that. I mean, you just think about the events of the year, right? How the dollar was basically used as a weapon this year, right? They shut off all the oligarchs, the financials for all the Russian banks, and the Chinese are looking at that and being like, okay, well, we have to like diversify, etc. Basically everybody, right?
Right. And they've all been, by the way, all the global central banks have been buying gold, stacking gold.
A couple, yes.
Not all, a couple.
They have been, and I think that's totally reasonable. But I tell you that if they already had Bitcoin on their balance sheet, they'd be stacking Bitcoin.
Yeah.
It's just because like
they have gold.
They have gold, and it's also the Chinese are a big driver of it, and they're obviously not, pro decentralization.
Right.
And so, like there's a lot of folks thinking very critically about money, the decentralization of it, and ultimately, I do think that puts a floor on Bitcoin, right? If you're some Saudi billionaire or some rich guy, you're constantly afraid of governments taking your money, you not having paid your taxes, etc. If you're a sovereign state, you're worried about
sanctions and geopolitics,
all of that. And so there is a real place for decentralized money.
Yeah, non-sovereign sound money is a use case.
And the bigger it is, and the more liquid, the more credibility it has. It becomes self-fulfilling,
right?
Et cetera. And I also think that one of the reasons, like, when Bitcoin was taking off, like, and one of the properties of money that you like a lot is stable value, right? The longer that Bitcoin can hover around 17,000, 18,000, whatever, and hold its value, the more constructive, the argument is. And like, that's what you want in money anyway. It's something that stores value well. I think in prior periods in the market, it's traded like a very speculative asset, and that's totally fine. I mean, just even think about the dollar. I mean, there were points where dollar yen had moved 30% in a year, and like Bitcoin moving down 65%. Isn't that crazy in the context of things? But taking a step back, the one lesson that I would give folks about regular currencies and G10FX in general, which are the 10 of the most prominent currencies out there, and throw in dollar China and a couple other EMs. But currencies are historically one of the biggest mean reverting assets on the planet, right? They will swing up and down in value, but you take a look at the 30-year chart of some of these currencies, they're right back to where they were 15 years ago, right? The ranges for currencies have already been established, except, EM that just, dollar EM
some
just
stuff goes crazy.
Goes up a lot, et cetera. But in the current world, I think it's fairly reasonable to expect currencies to be mean reverting for a while. And once you have critical mass in Bitcoin, it's going to behave that way. It is what I'm thinking in the long run, 5-10 years down the line.
Yeah.
So, Bitcoin back to 30K in 2 years, like that's so easy.
Yeah.
Right. Like if you establish a range of 30 to 60, like that wouldn't be that crazy either.
Yeah.
And so in a year where you've moved 65%, and in a year where inflation is going the other way now, most likely, we can get into that a little bit later, but we're probably going to see a negative month-on-month print this month.
Yeah. So that's tomorrow. We're recording on Wednesday.
Yep.
Tomorrow CPI is published, and then this comes out Friday. So hello Friday.
But yeah, so you're having dollar weaken this to start the year, yields move lower, stocks move higher. There's been an unwind of what was happening last year.
Yeah.
And so I think it's totally fair to make a prediction that you'll see a little bit of a reversal in Bitcoin as well in that kind of context.
Yep.
Right? If the dollar sells off by 10 to 15%,
You should see some absolutely
feedback into Bitcoin.
So CPI tomorrow. What are we expecting here?
So it's very interesting. CPI. There are a couple of things that matter about CPI. Or there's a lot of things, but in terms of like what I'm focused on as a trader is a couple of things, right? One, where expectations are, not just the number, right? If it comes in above expectations versus lower than expectations, that's going to dictate
most of the ball game, right?
That's the ball game for the move on the day.
Yeah, for the on the day move. Yeah.
Right. And so what's been happening is that a bunch of sell side institutions have been forecasting a lower number than what the economists were forecasting officially on Bloomberg. And so you've seen the Bloomberg month-on-month headline number go from 0 to like neg 0.1.
So I see. So now the Bloomberg the expectation is for a softer,
and so expectations have been moving lower over the past week, and I think that's totally reasonable given the data set that we have. One of the things is like just gas prices, right? Again, they've been moving down in November and December. That's a huge
one you can see on the Chevron or whatever sign as you drive by.
Yep, absolutely.
And you drive by every day and you notice that it goes lower. I mean, that's something that's actually one, it's like, that is one of the really interesting, inflation is so driven by like personal behavior, right? Like if people think things are expensive, they might buy less.
Expectations for inflation are just as important as inflation.
And this is a billboard that people all around the country see every day. That is their own personal check mark or sort of where they can follow inflation, quote unquote. And when gas gets cheaper,
that has a feedback loop into tons of other things.
Yeah.
And also expectations of where people think inflation is going to be. But in my head, and the way I think about inflation is it comes down to a handful of things, right? Rents, owner's equivalent rent. The Fed has recently published a paper about how CPI right now is sort of lagged in terms of how it looks at rents, and they have a new index. I forgot what it's called, but essentially it's already suggesting a slowdown in rents, and home prices have obviously sort of topped out and are moving in the right direction. So I think housing and rent, you're probably safe in that it's headed in the right direction.
And that isn't something that causes CPI to go higher.
It could, but it won't be as relevant because that it's backward-looking and the forward-looking and more high-frequency sort of data points suggest that it's constructive, right? And then you have sort of the consumer goods, right? And the consumer goods have been trending in the right direction, and having gas prices move lower are going to help them. And so one of the areas that we've been most concerned with that have been sticky has been in services pricing. Right, like things like medical goods and like leisure and hospitality services and things of that nature. Those prices have been relatively sticky. But what we had last Friday was ISM services that printed below 50 and showed contraction. Right, we also had average hourly earnings that moved lower, and so taking a step back, labor the growth in wages is also a key sort of component of our understanding of inflation, and that's also been moving lower, right? In terms of not moving lower, but the month-on-month increases have been coming down to reasonable levels.
The growth has been receding.
So, correct.
Yeah.
Right. So it's one thing to have a really tight labor market in terms of jobs outstanding and unemployed people, but it'd be another to have like everybody's getting 5-10% raises. Right. And so the fact that you're seeing the wage side of the inflation pressure is also moving down, that's good. And then with this CPI print, like you have used autos and things of that nature. So you want to see broad weakness.
Yeah.
And I think the market is set up
To
for
see
that right
yeah.
now. But I worry that the risk is that it comes in flat or a bit higher than expected.
Expectations are now very low. I see your
exactly.
point. This is the good setup for that
So
conversation.
I think expectations have been anchored to the downside.
Yeah.
And also, like if it misses by a little bit to the downside, which is good, right? Because expectations have already started to move and the trend, it might not impact markets that much.
Right.
But taking a step back, we're at the point now where basically, housing inflation, core goods inflation, consumer goods, some of the services stuff is probably going to start to turn. The labor side of the equation is starting to move in your favor. And this is going to be the third straight decline in CPI. And it looks like we've topped out, right? So you hit a peak and it's been moving lower and lower in a gradual way. And so the inflation picture in the U.S. is getting a lot better. And that's kind of what you're seeing in the market in terms of pricing. And it's led to a bit of a discrepancy between what the market is pricing and versus what the Fed is pricing. There's about a 15, 20 basis point discrepancy in terminal rate expectations. And then there's a bigger discrepancy in terms of when the Fed's expected to start cutting versus what the Fed's telling you, which is they're not cutting at all in 2023. This is that
great debate, right?
It's the great debate right now.
The market versus the Fed on rates. And yeah, it's going to be really interesting. It does. It feels like the second half of this year for risk investing is when a lot of people are feeling like rates will have paused, and you said markets even pricing perhaps cuts in Q4.
Yeah.
But that we still have both, perhaps generally in markets, but also in crypto, the first bit of this year feels like a continuation of a bit of the slog that we've been in.
Yeah, no, I think you're totally right. But my one worry about it is it's just so consensus.
Yeah.
Right? It's like everybody's like, oh, inflation's going to fall, then Fed's going to change its tune, back half of the year, risk assets are going to rally.
It seems like too good a story,
So good. Guys, I just worry about that because this inflation thing, it's sticky.
And it's scary inflation.
It's the one thing that I would say is different than other prior periods. There've been a lot of folks doing historical studies about how is this 70s style? Is this Great Depression? Been a lot of historical analysis, right?
Right.
And I think the biggest things that people are missing are, one, the excess reserve environment. What I mean by that is the amount of money that's just floating in the system that's just been printed over the past decade, right? You're talking about abundant levels of excess reserves. There is no scarcity of dollars, right? There's $2.3 trillion in the reverse repo facility, right? That is money that has to literally get drained out of the system because it doesn't want to buy any assets, right? It's excess, reserves that are in the banking system. And so there's a lot of money in the system that's just idly waiting there to get deployed, right? Once they get the signal from the Fed to deploy, right? And then you have this crazy investor fervor in the U.S. where the moment it's risk on, it's
pile in
meme stocks like crazy. I mean, the meme stocks today are ripping.
Are they really? I didn't see that.
Right?
Yeah.
And you'll see the same stuff.
You're right.
You'll start a speculative frenzy the moment the Fed turns around. And then it's okay, interest rates move lower, and it's demographically, people still want to buy houses, right? If home mortgage rates go from 7 to 5,
people are going to buy.
People are going to start buying again, right?
Man, it's hard to unwind this,
And then the other most important part of this that people are really missing is the labor market. You're talking about 3.5% unemployment rate. If you want a job, you basically have it. Right. And you're getting a good job because you're getting raises, et cetera. But it's not you have that much room to go lower. Right. If people have jobs, if they're stuck in 30-year mortgages that they got on 2 handles or low 3s. Right. People are going to spend money. They're going to feel fine. And the moment stuff goes back the other direction,
it could go hard.
It could go. The inflation cycle should just resume.
Yeah.
And so, I think people are dramatically underestimating how quickly inflation can pick back up once the Fed starts to turn. Because right now, I look look at the data set, etc. And everybody's like, oh, stuff's slowing down, etc. And then I'm like, well, did you look at consumer spending in Q4?
It's up.
Right,
It was high, right?
It's up. Like nominal growth is expected to be high. Like home prices haven't fallen off that much.
Right.
Yeah, you have like used autos.
That point
moving
you
down.
make though really scares me, and it's totally right, because the second everybody says, "Oh my gosh, it's time to redeploy and do more stuff," oh, the rates are going to come down, then that counteracts the whole mission of the Fed and could cause it. And this is the thing, you're talking about the historicals, right? In the 70s, like they tried to get inflation under control and failed multiple times before Volcker had to like drop the hammer, right? And
Absolutely.
that is a fear. Well,
And like that's what the Fed's afraid of, and that's why they're like so like aggressive about hammering home the point that they're not cutting this year. And that's like what they have to do, because it's always politically convenient to make markets rip.
And it's also about expectations, so they're trying to control expectations. We're going to keep this story going, man. This is going to be an interesting year. So I'll look forward to it. So that's it for now. Beimnet, Abibi, Galaxy Digital Trading. If you enjoyed our conversation with Beimnet here on Trading Takes, check us out on Galaxy Brains, our weekly podcast. Beimnet always joins us and gives his takes there.